China's economy faces debt risks amid slowdown and crisis. China, the world's second-largest economy, is facing multiple challenges as it tries to maintain its growth momentum amid a global pandemic, a trade war with the United States, and a domestic property sector crisis. One of the most pressing issues is the high level of debt that has accumulated over the years, posing a threat to financial stability and economic resilience. According to the Bank of International Settlements, BIS, China's total domestic debt rose to nearly 290% of gross domestic product, GDP, in the third quarter of 2020, up from 318% in the first quarter. This was the largest quarterly increase on record, driven by a surge in government and corporate borrowing to cope with the impact of COVID-19. China's foreign debt, which includes borrowings from foreign banks and investors, also increased to $2.4 trillion by the end of 2020, up 3.6% from a year earlier. The composition of China's debt is also a cause for concern. The corporate sector accounts for more than half of the total debt, at over 160% of GDP. This includes both private and state-owned enterprises, many of which are in sectors that are plagued by overcapacity, low profitability, and high leverage. The property sector, in particular, is facing a severe crisis as many developers struggle to repay their debts amid a slump in sales and prices. The most prominent case is Evergrande, China's largest property developer by sales, which has more than $300 billion in liabilities, and is on the verge of default. The household sector is another source of vulnerability, as consumers have taken on more debt to finance their spending and housing purchases. China's household debt-to-GDP ratio rose to 62% in 2020, up from 18% in 2008. This has increased the financial burden on households and reduced their ability to cope with income shocks or interest rate hikes. Moreover, some households have invested their savings in risky assets, such as wealth management products or peer-to-peer lending platforms, which could expose them to losses or fraud. The government sector has also seen its debt level rise significantly, especially at the local level. China's public debt-to-GDP ratio reached 45% in 2020, up from 27% in 2008. However, this does not include the off-balance sheet debt of local governments, which could amount to another $5.8 trillion according to Standard & Poor's global ratings. Local governments have relied heavily on borrowing from shadow banking sources, or setting up special-purpose vehicles to finance their infrastructure and social spending, often without adequate revenue sources or risk management. The high level of debt poses several risks for China's economy. First, it could constrain future growth by crowding out private investment and consumption. Second, it could trigger a financial crisis if defaults or contagion spread across the banking system or the bond market. Third, it could limit the policy space for fiscal and monetary stimulus in case of an external shock or a domestic slowdown. Fourth, it could increase the external vulnerability of China if capital outflows or exchange rate fluctuations put pressure on its foreign reserves or currency. To address these risks, China needs to implement a comprehensive and coordinated strategy to deleverage its economy and strengthen its financial system. This would involve improving the transparency and accountability of debt issuance and management, especially at the local government level. Enhancing the regulation and supervision of shadow banking activities and non-bank financial institutions. Restructuring or resolving the debts of zombie firms and distressed property developers, while protecting the interests of small investors and creditors. Promoting the development of a diversified and market-oriented bond market that can facilitate debt refinancing and restructuring. Encouraging more household saving and consumption by providing better social security and public services. Maintaining a prudent and flexible monetary policy that balances the objectives of growth stability and financial stability. Pursuing structural reforms that can boost productivity, innovation, and competitiveness in key sectors of the economy. China has long been the engine of global growth and a major creditor to low-income countries. However, its economic slowdown has alarmed international leaders and investors, who are no longer counting on it to be a bulwark against weakness elsewhere. In fact, for the first time in decades, China is itself the problem. By tackling its debt challenge head-on, China can restore confidence in its economy and secure its long-term development prospects.